of works its way out, because basically the National Association of Realtors were sued on the basis of that, saying that it was antitrust, it was colluding, and basically the realtors ended up settling and saying, okay, we'll stop doing that, and we're going to apply that nationwide. And this, this doesn't legally impact 100% of the realtors all across the nation, but virtually it will. Practically it will, because they're such a dominant force. It does cover such a large percentage of the of the nation in terms of number of realtors who are affected by this, that really kind of the whole market is going to go this way. And essentially, what changed is now sellers, realtors aren't allowed to require sellers to list a commission for the buyer's agent, as well as for the own agent that seller is bringing to the table. But what that means now is buyers who have historically never considered the idea that, hey, I have to pay my down payment, and I have to pay my loan cost, and in addition, I have to pay a realtor commission, which historically is run somewhere between 2% and 3%. If you're buying a $750,000 house and you have to pay 3% commission, that's another $22,000 in cash you have to come up with if the seller's agent seller is not paying for that commission. And so practically speaking, that's a huge hurdle for buyers to get over. And practically speaking, that would create a fairly substantial disadvantage for sellers who don't offer that commission to pay. That said, what it is going to do, absolutely, it's going to create a situation where every single commission is going to be the subject of a negotiation now, a discussion anyway, whereas in the past, it's always just kind of been assumed. And yes, it's always been negotiable on a technical standpoint, but practically speaking, there hasn't been a lot of conversation around that. Most of maybe the seller will have a conversation, with their agent and say, okay, I'm willing to pay 5% or 6%, but there really hasn't been a lot of conversation on whether I'm going to offer a commission for the buyer's agent. That's been kind of a given for a very long time. Now that won't be a given. And when this first came out, as with every kind of issue that has wide impact, you always have your shruggers and your shrillers, right? You have the people who kind of shrug it off and say, oh, it's nothing new, it's not really going to happen, impact anything at all. And then you have the really shrill people that say, the world as we know it has ended. And it's always kind of in the middle of that. In this case, I think it will be too. What you need to know as a buyer, if you're going to hire a realtor to go and represent you in a transaction, and I 100% recommend that you should each and every time, and whether or not how that commission is negotiated into your deal, I absolutely recommend you bring an agent to the table with you, because you don't want to go into it's not just that it is the largest transaction you will ever make in your lifetime for the vast majority of you, and by many folds over the next largest transaction, right? This is the most significant financial decision you'll ever make in your life. That in and enough is reason to bring a realtor, a professional, to the table with you. Okay, but it's even more than that. You're talking about a transaction where you're looking to buy something that has no objective way of valuing, right? A piece of property listed, whereas when you go buy a car, there are thousands and tens of thousands of identical cars. You want to go buy a Tesla, you want to go buy a Toyota, whatever you want to buy, there are thousands and thousands of absolutely identical cars out there in the marketplace that are being traded every day. So you have a very clear idea of what the value of that particular product is, no matter where you're buying it. That is not the case. There are no two pieces of real estate that are truly exactly alike. And so, appraisers and realtors have a way of saying, okay, these are comparable, but it's a very subjective process, and it's very hard to put your finger on that number. And so you don't want to go into that transaction unrepresented against a professional realtor who is representing the seller and ask them to help you set the price. And essentially what you're asking them to do is set the minimum price, because that's what you want to pay, right? The minimum price that you can get that property for. So I absolutely recommend you bring a realtor to the table each and every time, but you're going to need to negotiate that commission. And sellers agents are now required to bring a form to you and have you sign an agreement that's a broker agreement. So Form 41 in Washington State. I'm not sure if that's true across the nation. But basically that form is going to dictate several things. It's a buyer's agency agreement. It's going to say, first of all, how big of a geographic region that covers. And the kind of the default for that is anywhere in the world, you know, which is ridiculous, of course, right? But kind of the default is very broad and expansive. And maybe that's fine, but you know, the default will be anywhere in the state. You hire this realtor, it's going to default to say, if you buy a property anywhere in the state, whether you bring me to the table or not, you're going to pay me for this transaction. So that's how, you know, how far it extends, how long it goes. Some of them are transactional. Just, you know, some realtors will say, well, we'll sign one every time I'm going to make an offer for you. Most of them are going to require you to sign one for a period of time. You know, and some of them are going to be a month, some of them are going to be 3 months, some of them are going to be 6 months, maybe some of them longer. And I would definitely say to work on not going the long route on that.
Quick question on that. Theoretically, if you sign that form, it has a 3-month timeline. You work with one realtor for a little bit, and for whatever reason, you go to another realtor. If you end up making an offer buying a house within that original 3 months, you could theoretically still be obligated to.
I think if you get into contract within that 3-month period,
Yeah.
then you are contractually obligated, depending on how the rest of the agreement reads.
Yeah, sure.
But yes, you are contractually obligated to pay that realtor whether they were there or not. So how long that goes, how much is the commission? That's another thing you're going to go negotiate with them. And then the fourth thing is key is who pays. And that's really kind of where some of your protections can be is, you know, it'll say, look, if, you know, you agree to pay me, let's say it's 3%. You agree to pay me, the buyer's agent, 3%. And then there'll be the scenarios that say, okay, if the seller pays at least 3%, then there's no conversation to be had. You know, we've agreed to that. They've agreed to pay it. You don't have to worry. When we get into contract, I'll get my 3% from the seller. But what if the seller only offers 2%? You know, then there's different paths you can take, and the agreement will stipulate that. Do I reduce my compensation as the agent to 2%, or do I take 2% from the seller and 1% from you out of pocket, or do we negotiate with the seller on that, or do we just say we're not going to do the deal if the seller doesn't pay? And all of those are on the table. So anyway, just be aware of those things. Be aware that you're going to have to sign the Form 41. Be aware that there are choices you can make on that Form 41 that limits how geographically wide that is, how long it's going to last, what that commission is going to be, and how it's going to be paid. And just go into that informed. But do bring a realtor, you know, with you to this most important transaction. Sorry, I got into podcast mode, so I'm not sure if that was
perfect
right for this live version, but there you go.
So one possibility theoretically maybe from this result from this could be kind of different, straying a little bit from the standard like 3% every time commission. Just anecdotally, Cole, Daniel, any of you guys, have you seen any variation in that, or has it still been pretty consistent generally, or are you noticing much change in that? You as well, Dan?
I've been pretty removed from any of changes as far as realtor negotiating for realtor commissions so far, but I mean, it's taking effect in July, right? So, right.
Okay, so it's not the results from the lawsuit don't actually come into play.
That's what I thought.
Well, in the state of Washington, they changed the law in January requiring a broker agency agreement to be signed. So we're already seeing that in Washington. But you're right, the actual settlement has not taken effect yet.
Okay. Is that in July, or do you know?
I don't know if they have a definitive date yet, but yes, I think the target date is around July.
Yeah, so so far I haven't seen anything, but
You know, seeing it's still 3% generally, or maybe 2.5%. For
yeah. I mean, usually 3%, and then
Yeah.
however that's split up amongst the broker and the realtor.
yeah.
Yeah,
Do you
3%.
expect that to change?
Yeah, well, I think it's like anything, you know, anytime you take, especially a service that is, you know, let's face it, that's a lot of money, right? It's a very, you know, when you bring somebody, you know, you buy an $800,000, let's make the math easier, you know, 3%, that's $24,000, right? If you know, that's a big number. And I think anytime you take something that was just an assumed number, and then you say, okay, now we're going to have a specific conversation about what I'm going to be paid. there's only one way for that to go, right? That's only going to bring pressure downward on that commission. It's never going to create upward pressure, right? It's not going to be, okay,
Yeah.
let's have a conversation. It's not really going to be 3, we're going to go to 4 now because we're talking about this. There's going to be pressure. And but there, you know, but it's still going to be a negotiated thing. I did hear of one where anecdotally, you know, one of my realtors had a transaction. They had an agreement with the buyer to pay them 3%. They got into the transaction. The seller was only paying 2%, and they basically negotiated a higher sales price with a higher commission so that the seller netted where he wanted to net. The buyer ended up paying it. And that's what happens with a lot of these things. It ends up being a lot of form over substance, right? You know, you end up structuring things to get to where you used to be, but you just have to go through a lot more hoops to get there. Now, I do think there'll be real downward pressure in cases, especially as the settlement gets put into place and the awareness of it and the impact of it gets felt. But I don't think we're, you know, I don't, it is going to, I think it is going to filter some additional agents out. I've already heard of, you know, at least one I know of who just told me, now this person was really new in the business and it was really kind of a very kind of a side gig for him. So it wasn't that big of a deal to him. But when this came into place, he just said, I'm out, you know, I just, it's already hard enough to get business. I'm not going to go and work on, you know, signing these deals with my buyers. So you know, I don't think that's the majority of them, but I do think it's going to weed out, you know, some of those people who just aren't deeply committed to the business. And so there'll be some of that pressure.
Yeah. Cool. Well, that's really helpful. Thanks, Dad. We're gonna move on. We have 2 more topics. We're gonna get to just kind of interest rates in general right now, and then we're also gonna get to somewhat new product, 0% down product that we're gonna cover. Dad has a couple videos on that, the results of the NAR lawsuit and everything to think through there, both kind of as a realtor or as a buyer on this channel on Mortgage Mastery Theater on YouTube. So there's a lot more information on those. Cole is going to cover interest rates, what's going on in the market right now. Guys, still feel free to chime in, add thoughts, ask questions along the way. But Cole, what's going on there?
Yeah, so I thought I would just start with a general breakdown of what people, you know, everybody asks us what are rates these days,
Right.
and everybody kind of pays attention to what the Fed says, but they don't have the time of day to look at their comments in depth, and they don't really know
what that means.
What the real consequences are of Fed comments. Like, how does it affect me as a borrower, as a consumer? And so I just wanted to talk a little bit about generally the relationship between what borrowers are saying, meaning when they say rates, and then what the Fed is tracking as far as when to cut rates. So generally, rates, when the Fed is talking about cutting rates, they are talking about the federal funds rate, which is the overnight rate that banks charge each other for borrowing money from each other. So that rate is not what mortgage rates are. They affect what mortgage rates are because we are downstream from those rates. So if the cost of money upstream becomes higher, then downstream the cost of money is going to become higher as well. But the federal funds rate, the rate that the Fed is in charge of whether they cut or raise, that is the federal funds rate that is only directly related to banks. Now, downstream from that, you have mortgage-backed securities, and you have, downstream from that, you've got the just interest rates that a borrower is charged when they're under contract for a home and lock their rate. And that's all dependent on credit and amount down and other compensating factors. But that rate is affected by both what the Fed charges for the federal funds rate, what they determine, but then also it's determined basically by supply and demand for mortgage-backed securities on the real estate investments secondary market. So basically, the mortgage-backed security is a price. It's basically it factors measures the demand for mortgages from investors on the market. There's typically tends to be a inverse relationship between the 10-year yield and the price of a mortgage-backed security. When the mortgage-backed security price goes up, that means the demand is going up for them, which typically means that rates are coming down. So it's good when the price of a mortgage-backed security goes up. Good for consumers because that means rates are coming down. So that's a general breakdown. It's so easy to get stuck in the weeds or fall into speaking jargon there. I'm trying to avoid as much
Yeah,
jargon
I think that's helpful.
possible and just break it down. But yeah, if that was confusing, I can try to break it down more. My goal is just to help people get a general understanding of, like, as far as not an in-depth, they don't need to have an in-depth understanding if it's not their industry. If they want to, great. But if they just want to know, why does this affect me, then that's what I want to provide. As far as what the Fed is trying to do, I think people generally know they're trying to bring down inflation. That's why they increased rates to begin with, because I was just looking at the inflation data. A year ago, June inflation was 9.1%. And we are currently at 3.27. So inflation, the rate of inflation has come way down. We haven't dropped inflation. If that were the case, it'd be a negative number, but we're still experiencing inflation. It's just slowed down. So now we're at 3.27 or thereabouts. The Fed has said that they want to hit an inflation rate of 2%. So we are close there. And it's even just a progress towards that helps rates, right? So it's not like once they get to 2%, that's when rates drop. Rates drop in response. What were you saying?
They're acting on the trends on what's going on right now.
They respond. This is basically just investors pulling their money or putting their money into the mortgage market. So when they put their money in, when the mortgage-backed security price is going up, that means investors are putting their money in. The demand is increasing for rates, and that's because they think rates are coming down. Money is becoming cheaper to borrow, so it's invested into mortgage-backed securities. So they're responding to comments from, definitely the big comments that they respond to are from the chair, Jerome Powell, at their monthly meeting in Jackson Hole, Wyoming, and their press conference.
You're talking about mortgage-backed securities are responding to these?
Yeah.
Okay.
Buyers of them.
Yeah. Just in general, the price of the mortgage-backed security. It's also looking at what reports are coming out. The BLS jobs report. Is unemployment rising? That means if unemployment rises and that shows up in the BLS job report, then that means that we are a step closer to bringing inflation down because the economy is slowing down. So people are going to be spending less. So rates are probably going to improve in response to unemployment rising. If unemployment decreases, and if that comes out in the job report, then rates are probably going to increase because people are saying, oh, we've lost some progress towards the Fed's goal of slowing the economy down, basically, which is basically what lowering inflation is. So that's, it's all happening in response to different comments from Fed members and reports that come out from different bureaus.
Yeah.
So
so what's going on right now? Or just with rates in general. No.
Right now, I mean, last week was very volatile. 2 weeks ago, we had a great growth in mortgage-backed securities, which is, again, good for borrowers. It means lowering mortgage-backed securities price goes up, mortgage rates come down. So good week 2 weeks ago. Last week was quite volatile, just in response to some lag reports. Honestly, I can't remember what report that was, but we lost a little bit of progress. They are the mortgage market gurus that we follow that are recommending whether to float rates or lock before something bad could happen and rates increase, they're recommending floating. And so, and typically they prove to have been right. They've been wrong before, and you know, so we monitor that. But the Fed today, Fed comments, we had a couple conflicting comments. We had one Fed member saying things are really starting to slow down, and we should probably, inflation isn't the only thing, we should probably look at cutting rates. But then you've got another Fed member, they're not colluding here. They're just kind of giving their opinions on the market. They're asked, and that makes it to the media, and that's what it can affect rates. And so another Fed member is saying, well, we might need to continue to keep rates high. Other Fed members are saying, what, like, I don't know what she's talking about. So it's not necessarily always a colluded thing. But the market does respond to different comments that come out that, like Landon said, indicate trends towards a goal. So we just recently had the Case-Shiller index come out, which is the measure of the price of homes, the average price of homes. And in April, it showed as a 0.3 increase. So it raised 0.3%, which is actually to an all-time high right now.
Sorry, what raised 0.3%?
The average price of homes.
Yeah.
So even though, you know, which is not necessarily fully related to the value, but it tends to be. And so, you know, rates went up in 2022, maybe the end of 2021. There's a lot of fear about, are we going to have a crash? But it's still proved to be a great investment for real estate, and continues to be so. And we're also one of the reasons we say we don't think there's going to be a crash. One, because of all the documentation and you have to be able to afford homes now, right? Before 2008, you could state your income, you could state your assets. You didn't have to really prove that you could afford the home, and now you do. And so these are,
like, you don't have
clients,
people in homes who got a loan even though they can't really, like, there's
no
a lot more.
business getting the loan,
Yeah.
right?
Okay, yeah.
And so, and then also the inventory, we are still very low on inventory. And so if it's one thing, if there were just so many houses more than there was a demand for, they were just sitting on the market. But the thing is, people are they're reluctant to let go of their lower interest rate and sell their home. And so that's keeping inventory quite low, and you know, helps to fight that over demand for homes, combined with that the lower interest rate, cheap money, easy money. So I'm not concerned about a crash. You know, for me, I'm never going to lie. I'm never going to put somebody into a home that can't afford one. I'm never going to commit mortgage fraud. You know, so for me, it's a great opportunity to be able to help clients get into a great investment, and you know, help them with like Chris, my dad, was saying, the biggest purchase of their lives for most people. So I really love what I do, and you know, it's been obviously a fascinating time to follow the mortgage market, and my goal is just to help simplify it and eliminate the jargon for the end consumer.
Yeah, awesome. You guys, anything to add?
Oh, thank you.
Yeah, it was good.
Cool. Yeah, well, let's get into the zero down. So, you know, I don't know what could you say 3% has generally been kind of the minimum down payment you can make?
For most people. Yeah, I mean, there's always been VA loans with zero down. There's always been down payment assistance programs out there with zero down. But widely accessible programs, you know, with conventional first-time home buyer, 3% has typically been what's the most widely accessible.
And those, so now, so I think I've seen a couple lenders kind of coming with something similar, but one of the lenders, we're brokers, and we brokered at different lenders, and one of the lenders we use consistently And one of the biggest lender in the country, UWM, has recently come out with a product to make that 0% down much more accessible. So Daniel, you want to share a little bit about what that is, how it works, who it's available to?
Yeah. So like you said, United Wholesale Mortgage in mid-May came out with a new product called their 0% down product. And like you were saying, it actually follows those 3% products, the Fannie Mae Home Ready and the Freddie Mac Home One. But basically, where the 0% down comes into play is UWM will actually pay for that, the lesser of 3% or $15,000 as a second loan, which becomes a second lien. And that loan does not accrue interest. You don't pay monthly payments on that loan, but it is due in full whenever you refinance, sell, or pay off the mortgage. So this is a really great tool, especially for lower income clients to get into a home that they can't afford the down payment. So basically, like I said, there's no monthly payment on it. You don't pay interest. It's just due as what they call a balloon payment whenever that mortgage is paid off, whether you're selling your home, whether you do a refinance, or whether you pay off the first in general. Until then, you
So
don't have to
because
pay on it.
technically, in order to get the pricing, the interest rates of a 3% down, you still have to you're still technically bringing that 3% down payment, you're saying?
Yeah, so typically when you're qualifying for the Fannie Mae Home Ready or the Freddie Mac Home One products, you would have to come in with that 3%. So basically, the difference here is UWM is coming in with that 3% for you, and you pay them back theoretically when you've gained the equity in your home when you're ready to sell or refinance. That's the theory behind it. So it helps borrowers get in initially without any money down, and the hopes are that you will have accrued some equity by the time you're ready to move or refinance, and that money can be paid back at that point. So it's a good way to get in, especially for first-time home buyers. So there are some parameters behind this product. It has to be a 30-year fixed loan. Can't be an ARM. Can't be 15-year, 20-year. It's got to be a 30-year fixed. Has to be a one-unit property, either a single-family residence, planned unit development, or a condo. Can't have a manufactured home. Can't have a duplex or anything over one unit. So for the Home Ready side, the Home Ready product, basically you have to qualify with a minimum FICO credit score of 620, and you can't make over the what they call area median income of 80%. So whatever the area median income is in the area where you're purchasing the home, if you make over 80% of that, you can't qualify for the Home Ready aspect of this loan. You have to make 80% or less. Now, if you make 50% of the area median income, UWM will also give you a $2,500 lender credit. That'll go as part of your down payment, but that'll just be $2,500 that you do not have to pay back of that 3% or $15,000. So for instance, if you have a $500,000 loan amount or greater, UWM will give up to $15,000. If you also qualify for that $2,500 credit, you only have to pay back $12,500. That's
So
kind of
that
how
2,500 basically becomes a grant.
exactly.
From UWM.
Yep.
Darren, are there any of these programs that are available to people over 100% AMI?
Yeah, so I'm getting to that right now. So that's actually, if you're a first-time home buyer, it's actually even better. That's where the Freddie Mac Home One product comes into play here. So you have to have a FICO of at least 700 to qualify for this one. But if you're a first-time home buyer, it doesn't matter how much money you make. There's no limit. Doesn't matter how much of the percent of the area median income you make. You can qualify for this product just simply being a first-time home buyer and having a 700 credit score. And just like
So
the
you
other
could
one,
get it even if you're not a first-time home buyer, if you're under a certain.
correct. If you're not a first-time home buyer, if you make 80% or less, you can qualify for this, and you can have as low of a credit score as 620 FICO for that. But say that you made some pretty good money and you're a first-time home buyer, you're buying your first home, you make over the 80% of the area median income. As long as one person who's purchasing this home is a first-time home buyer, you can qualify for the first-time home buyer. Now, a caveat to that is you don't always have to literally be a first-time home buyer, meaning you've never purchased one in your life. If you haven't purchased a home or owned a home, I should say, within the last 3 years, they actually classify that as a first-time home buyer. So let's say you've been renting for the last 3 years and you go to purchase a home, you can actually qualify as a first-time home buyer again.
I'm gonna
So,
put, oh, sorry, Daniel, you
no, go for
more
it.
on it?
Yeah, I do. Go. Do you have a
Perfect.
question?
Yeah, keep going.
Yeah, so there's some other nice things about this product. If you're getting a large seller credit and you wanted to qualify for what they call the temporary rate buy down, basically means, if you're not familiar, you can use a seller credit to temporarily buy down your interest rate, say the first year, 2 years, or even 3 years, depending on the product. You can qualify to pay less of an interest rate for that term, and then your interest rate goes up. A lot of times, the value in this product comes when you're going to interest rates are higher like they are now. You want a lower interest rate for a couple of years, and then the theory is hopefully interest rates will be lower by the time that term is ended and you refinance out of that. So you can still qualify to use a temporary rate buy down with the 0% if you're getting a seller credit and you're purchasing the property. So that's kind of nice. One of the other parameters is they do not allow high balances. So whatever the max loan amount in your area is, you have to stay within that for the 0% down. So if you're $1 over the max loan amount in your county or area where you're buying, you can't qualify for the 0% down. So that's just
Which means it's the same everywhere across the nation. It's
Right.
because they don't allow high balances. That would only bring variation in specific counties.
So what is that, like 770 something? 776 or something?
766.5 maybe. Sorry, yeah, here we are, all the experts. We should know this. Let me just look it up. 766.550. So basically, anywhere in the nation, 766.550, and anywhere in the nation, 766.551. You're toast.
No, 0 down.
Yeah. Cole, you're quiet. You're muted.
Issue. Does that relate to like King County, which is they have a higher loan limit?
So I believe it's whatever area you're buying the property in is the
Well,
limit, correct?
so, but that's what Daniel was just saying, is that there are no high balance loans available to this. So,
Oh, I
so
see.
King
Got
County
it.
is going to be 766.550.
Because the conforming loan limit is universal, but then there are some areas that are not jumbo, but they're high balance.
Yeah, they have
Does that
these
make sense?
special Fannie Freddie programs that are called high balance. But the baseline number is the same everywhere in the country. And so basically that means everywhere in the country, 766.550 loan amount, you could potentially be eligible for this. And nowhere in the county can you be eligible if your loan amount's over that. Yeah, nowhere in the country. Yeah.
Got it.
Cool. Daniel, anything else? That's super helpful.
Yeah, no, that's kind of everything in a nutshell. I mean, there's not too many other, takeaways that I have, but I think that pretty much covers it. So pretty straightforward.
I'm gonna quickly, we'll wrap up here in a second. I'm gonna quickly put you guys on the spot with I'll give you 60 seconds each. Would you consider, in what situation would you consider using this product personally? Or would you deem it a good option? Why or why not? Daniel, I'll let you start since you did all the research.
Yeah, so I mean, for me and my wife, sorry, I'll try to go fast. When me and my wife first got our first home when we got married, we did not have much to put down. So we had an FHA 3.5%, which is another great product to get into, but we had to pay that mortgage insurance, which is higher on FHA. I could see myself not having enough down, knowing I'm going to be living in a place where the equity is going to go up, especially in a time like right now where the interest rates are higher. I think the 0% down is great. If down payment is what you're concerned with, I think this is a great place to get in. If you can afford the monthly payment, and because there is mortgage insurance, it's not usually as much as FHA, but if you can afford the monthly payment, but not the down payment, you're starting a family you really want to own, I think it's a great product to get into. If it was me and I could go back when I first bought our first house and this was available, I think I would go with this over the FHA. Done.
Nice, 52. Cool.
Yeah, I think if you are making, I mean, I think there are plenty of people that come out of college or come out of high school, and there are a lot of ways to make a lot of money in this country. So I think, it's common for, there are people out there that are making great money. They just haven't saved anything yet. And, they're on a salary job. I think that's a great product for someone to get in. They're confident in themselves. Obviously, you're taking a bet out on yourself that you're going to keep your job. You're going to keep working hard, and keep making the money. You don't know what the future holds, but, for those people, I think if the income is steady and solid and likely to continue for all they can see, then I think it's a great product. Obviously, if you are not confident, if you can qualify, but you're not confident in your ability to hold a job, it's probably not the best product for you. But so obviously it comes down to, are you going to work hard? You're going to keep your job, and can you qualify?
Nice. 105 within the leniency window.
15
Dan?
seconds leniency.
Yes. So I would say this is a great product for someone who wants to be an investor, someone who wants to buy houses, live in them for a time, and then hold on to that property and move on to the next one and accumulate kind of doors, what they call, the people who manage large amounts of rental properties. You got to start somewhere, and if you want to start out young and say, look, I want to buy a house. Of course, buying a house as a primary residence, owner occupied, is the cheapest way and the lowest down payment. So you're conserving capital this way, and basically saving up so that you can make that next move. And of course, when you buy a property as a primary residence, you have to have a genuine intention to occupy that property as a primary residence for a year. But as long as you can meet that condition, then after a year, you can have a full intention to say, okay, I'm going to hold it for 1 year, and then I want to keep it as an investment property. Well, now you've got into an investment property that you bought with primary residence interest rates and with very little money into the deal. And so you've got the opportunity then to save up during that first year, go buy your next property. Again, you're buying a new primary residence. And you can get that, let's say 5% down or so. So you can kind of keep leveraging that way.
Nice. Dad even set himself a timer.
Yeah, but unfortunately, it
He
was a
went to-
30-second timer and it kept ringing in my ear for the last 30 seconds.
Well, he was outside the leniency window, but he owns the company, so we'll give him some.
Oh yeah, how long did they go for?
120.
Oof, maybe that timer was real. Maybe it was a minute.
Yeah. I'm going to use my 60 seconds to kind of raise one question. If you have the money for the down payments just sitting in a savings account, and you're not going to use that elsewhere, would that be a situation to consider? Daniel, is the interest rate you get with 0% down, or the mortgage insurance, is any of that affected by going with this product versus you putting the 3 or 5% down?
Yeah, I've priced it out. Interest rates do seem to be a little bit higher than actually putting in the 3% down yourself. So, I mean, in my opinion, if you have the 3% ready, I would consider using that instead of getting the second
But
loan.
it's not to the point where it's like you should not ever consider that, like the amount it's higher.
Yeah, no, we're talking, I mean, we're talking a difference of minimal monthly payment with, I mean, we're not talking 2 or 3% more. It's less than 1% difference usually, but it is different. Sometimes every dollar counts for people. So
yeah, cool. Okay, super helpful. Thanks, guys. Well, I am going to wrap us up. Thank you all future people for watching. We had maybe 2 watching during, which is great.
Thanks, Mom.
You. Yeah. So thank you for watching or listening. We're going to do these on YouTube on Tuesdays live. So if you're listening on podcast, you can check it out on YouTube and put any questions or comments there. If you're watching on YouTube and regularly, but you miss it 1 week, we'll be doing them on our podcast, which I will try to link in the description on YouTube. We are licensed in Washington and Idaho. So whether you're a realtor looking for a great lender partner, or you're not in the industry at all, but you or a friend are looking to buy or refinance, we'd love to be of assistance. So check out our info in the description, or just go to clevelandstreet.com and reach out. We'll see you next week.